Free is not a price, it is a business model. When a financial application offers zero-cost access to budgeting tools, investment accounts, or payment infrastructure, it is not acting charitably. It is operating within an incentive structure. The value it extracts exceeds the cost of the service it provides. The question is not whether that extraction is occurring. The question is what is being extracted, where it goes, and what structural consequence it produces. For the person who believes they are the customer, that question is not rhetorical, it is architectural. In the conventional economy, when you purchase a product, the transaction is explicit. You exchange money for a good or service. The relationship is defined. In the attention and data economy, the transaction is implicit. You exchange behavioral data, financial information, spending patterns, and decision-making signals for access to a platform. The platform is not your service provider, you are its inventory. This distinction is not rhetorical. It determines whose interests the product is actually designed to serve. Once that is understood, the architecture of free financial services becomes legible in a way it was not before. The mechanism operates through several overlapping revenue structures, each one extracting value from the user's financial behavior in ways that are disclosed in terms of service, but rarely understood at the structural level. The first and most direct mechanism is data monetization. Financial behavior data, what you spend, where you spend it, when, and how your balance fluctuates, is among the most commercially valuable data a corporation can hold. It predicts risk, creditworthiness, purchasing intent, and behavioral response to marketing stimuli with a precision that demographic data alone cannot approach. When a free budgeting application aggregates your transaction history, it is building a behavioral financial profile. That profile can be used internally, sold to data brokers, or deployed through digital advertising partnerships. The second mechanism is payment flow economics. Applications that handle actual money movement generate revenue through interchange fees, processing margins, and float income. Float income is earned when a platform holds uninvested cash balances and earns interest before those funds are deployed by the user. At sufficient scale, millions of users, small idle balances, it generates meaningful revenue. The user receives no yield, the platform captures the spread. The third mechanism is order flow monetization, which became widely visible through the regulatory scrutiny of Robinhood beginning in 2020 and 2021. Robinhood's model, zero commission trading, was made financially viable through payment for order flow. Rather than routing trades to exchanges offering the best execution price, Robinhood routed them to market makers who paid for the privilege of executing those trades. Those market makers profited from the spread between bid and ask prices across millions of transactions. The user paid no visible commission, but absorbed execution costs through marginally inferior trade prices. In December 2020, the Securities and Exchange Commission charged Robinhood with failing to disclose this arrangement adequately, resulting in a settlement of approximately $65 million. The structural mechanism in each case is identical. The user believes the service is free because no line item on a receipt says otherwise. The extraction occurs through information asymmetry. The platform understands the value of what it holds. The user does not. The platform and its data partners capture revenue from behavioral and financial data the user has generated. The user absorbs the cost through reduced execution quality, foregone yield on idle balances, and the commercialization of financial patterns they did not explicitly offer for sale. The aggregate value extracted from a user of free financial services over a multi-year relationship, through float, order flow, and data monetization, can materially exceed what that user would have paid for a transparently priced alternative. The free product is often the more expensive one. The structural pattern of value extraction through information asymmetry is not a product of the digital economy. It is a recurring feature of how financial intermediaries have always positioned themselves between capital and the individuals seeking to deploy it. The most instructive historical parallel is the commission-based brokerage model that dominated retail investing throughout most of the 20th century. For decades, retail investors accessing equity markets were dependent on brokers who charged explicit commissions, while also benefiting from practices, including directed order flow and proprietary trading against client positions, that were not always disclosed. The investor understood the commission. the investor often did not understand the full cost structure of the intermediary relationship. The information asymmetry was structural and sustained. The mutual fund distribution system offers a second parallel. For much of the late 20th century, mutual funds sold through financial advisors embedded sales loads and distribution fees into fund structures, disclosed in prospectuses, but rarely communicated clearly to retail investors at the point of sale. In 2012, the Securities and Exchange Commission conducted a review of these fee structures and acknowledged that the disclosure framework had not functioned as intended. Investors were systematically paying fees they did not understand for services whose value had not been demonstrated. The structural incentive was clear. Advisors had financial motivation to recommend higher fee products that were not necessarily aligned with client interest. The regulatory history of the United States financial sector shows a consistent pattern. Disclosure requirements expand in response to documented harm. Enforcement follows market failure. New products emerge with modified structures that replicate the underlying asymmetry in less visible form. Free financial applications exist within this cycle not as a novel aberration, but as its current expression. The same information asymmetry that characterized commission-era brokerage and opaque mutual fund distribution now operates at scale through digital platforms, with the added dimension that behavioral data extracted today informs commercial relationships the user cannot observe and may not anticipate for years. The first observable consequence is the erosion of financial privacy as a structural condition. Every transaction routed through a free platform, every account linked for aggregation, every balance and spending category recorded contributes to a profile that persists, is sold, and informs decisions made by parties the user has never directly transacted with. Insurance pricing, credit offers, marketing targeting, and employment screening in some jurisdictions can draw on data ecosystems that include commercially sourced financial behavior data. The user who linked their bank account to a free budgeting tool did not consent to that downstream application, but the data flow that enables it was initiated the moment the connection was made. The second observable pattern is the concentration of systemic risk in centralized data infrastructure. Free financial platforms aggregate the data of millions of users into centralized repositories that become high-value targets for breach, regulatory seizure, and compelled disclosure. The 2019 breach of Capital One, which exposed the financial data of approximately 100 million individuals, was made possible in part by the concentration of data that financial services infrastructure creates as a byproduct of its operating model. The individual user's exposure is not limited to the platform they directly use. It extends to every aggregator their data has flowed through. Gary Gensler, serving as chair of the Securities and Exchange Commission from 2021 through 2025, oversaw regulatory proposals concerning digital platforms and payment for order flow, addressing whether zero-commission models adequately disclosed their true cost to retail investors. Lena Khan, serving as chair of the Federal Trade Commission across the same period, oversaw investigations into data broker practices and platform data monetization, addressing how consumer data collected in one context is used in commercial contexts the consumer did not anticipate. The regulatory posture of this period reflected a growing institutional recognition that the information asymmetry embedded in free digital services created structural harm that earlier disclosure frameworks had not been equipped to address. The positioning implication for a rational actor: every financial tool that is free has a cost structure. It is simply not presented as one. Understanding that structure is a prerequisite for evaluating whether the service is genuinely advantageous or whether the apparent convenience conceals an extraction relationship. The free financial service is not a product offered to you. It is a product built from you. That reframing does not require outrage. It requires accuracy. When the incentive structure of a platform is understood, its design choices become legible. Why aggregation is encouraged, why linking accounts is frictionless, why the interface is optimized for engagement rather than transaction efficiency, why data permissions buried in the terms of service are as broad as the legal standard permits. The structural question worth asking before adopting any financial tool is not whether it costs anything. It is who the platform is actually serving, how it generates revenue, and what the user provides in exchange for access. Those questions have answers. The answers are documented, disclosed in regulatory filings, described in investor presentations, visible in enforcement actions when disclosure has been inadequate. An individual building financial sovereignty is building a relationship with their own financial data that is as deliberate as their relationship with capital. The two are not separable. Financial data is financial infrastructure. It determines credit access, insurance pricing, the targeting of financial products that may or may not serve your interests, and, in an environment of expanding programmable financial systems, potentially the conditions under which financial access itself can be modified. This is not speculative. It is the current architecture of the system you are operating inside. Understanding it does not require abandoning every digital financial tool. It requires understanding what each tool costs, in terms you can measure, not just the ones denominated in dollars. This is 21 Protocol. Freedom is not a feeling, it's a structure.